Have you ever wondered what central banks do to give the economy a boost when things slow down, encouraging more spending and investment? Expansionary monetary policy primarily uses three key tools to increase the money supply and stimulate economic activity. These are lowering benchmark interest rates, engaging in quantitative easing, and reducing the reserve requirements for banks. Each of these actions aims to make it easier and cheaper for businesses and consumers to borrow and spend, thereby injecting vitality into the economy. The core mechanism behind these tools is their ability to influence the availability and cost of money in the financial system. When a central bank lowers its policy rate, such as the federal funds rate target in the United States, it directly reduces the cost for commercial banks to borrow from each other overnight. This lower cost filters through the banking system, leading to lower interest rates on loans for consumers and businesses, making borrowing more attractive. Quantitative easing involves the central bank purchasing large quantities of government bonds or other financial assets from commercial banks. This injects new money into the banking system, increasing banks' reserves and their capacity to lend, while also putting downward pressure on long-term interest rates. Finally, reducing reserve requirements means that banks are mandated to hold a smaller percentage of their deposits in reserve, freeing up more funds that they can then lend out to the public. Central banks strategically deploy these tools to counteract economic slowdowns or periods of low inflation. For instance, after a recession, a central bank might dramatically lower interest rates and implement quantitative easing to kickstart demand and encourage job creation. These decisions are carefully considered, often based on economic indicators like gross domestic product growth, inflation rates, and employment figures, aiming to achieve mandated goals such as maximum employment and price stability. The central bank's policy committee, like the Federal Open Market Committee, evaluates these indicators to determine the most appropriate course of action. It is fascinating to understand the subtle but powerful interplay between these policy instruments and the broader economy, often referred to as the monetary policy transmission mechanism. While lowering benchmark rates is a conventional tool, quantitative easing is often considered an unconventional policy, typically used when interest rates are already near zero and further cuts are not possible. Both methods, however, work to stimulate aggregate demand, though through slightly different channels, ensuring liquidity and encouraging lending even during challenging economic times. Ultimately, these tools are designed to guide the economy toward its full potential, ensuring a healthy flow of money that supports sustainable growth and keeps prices stable. By understanding how a central bank increases the money supply and makes borrowing more affordable, you can better grasp the broader economic cycles and the strategic efforts to maintain prosperity and mitigate downturns for everyone.